Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. And I have some exciting news for everyone today, because for the next few weeks, we're going to be doing something a little bit different with the show, putting a pause on the ongoing Becoming Buffett series we've been doing on the podcast, because on June 27th and 28th of 2017, just a few weeks from now, we're going to be having our mid-year DIY investing summit in partnership with Seeking Alpha. And it's going to be an exciting summit. We're going to have a lot of some of my favorite investors from Seeking Alpha are going to be a part of this summit, and we're going to have all kinds of topics, everything from what their favorite picks are, specific favorite investments are going forward from here, how they're shaping their portfolio for the second half of 2017, how they're hedging their portfolio in light of markets being at all-time highs, as well as how they go about identifying major trends and how do they identify companies to invest in, how do they research them, how do they make buy and sell decisions, all that stuff and more. So I hope you enjoy this preview of the DIY Investing Summit, and you can register for the summit for free at DIYinvestingsummit.com. That's DIYinvestingsummit.com for your free registration. Well, Eric, welcome to the DIY Investing Summit.
Well, thanks, Brian. It's good to be with you today.
What would you say are signs that you're watching for that the bull market would be coming to an end?
I would say, the bull market in stocks, I guess the first thing to watch for is any sort of sustained selling pressure. I mean, the one indicator that I'm watching as a leading indicator more than any other is the rate of change or I guess just the absolute size of collective global central bank balance sheets. They're continuing the balance sheet of the Fed, the European Central Bank, the Bank of Japan, and the People's Bank of China. If you add the four of those together, those combined balance sheets are continuing to grow. And one of the challenges that's faced the U.S. Federal Reserve is they want to tighten monetary policy, but monetary conditions have on net eased since they have started raising interest rates, because there's still a ton of money that's pouring in from the ECB and the Bank of Japan. And one of the first thing that I'm watching is for some sort of topping out and rolling over of global central bank balance sheets, because that will mean that the net addition of liquidity is finally stopped. Then the next thing I'll be looking for is, when does that start to feed through to the stock market? And we're not seeing any sign of that right now. So one of the risks, and it seems kind of strange for some people to kind of hear me describe this as a risk. One of the biggest risks I think the stock market faces in the second half of the year is not a break to the downside, but a break to the upside, where the stock market just can't go down on any given day anymore. Yeah, it'll go down like to 3 or 4 points on the S&P 500, but it doesn't go down 10, 12, 15, 20, 25 points on any given day. It did once on a Wednesday a couple of weeks ago, and it made all those points back in like 3 days. So it's demonstrating the inability to go down, and the liquidity is still pouring in. At what point does it just start to take off to the upside and start to go into kind of that blow off top phase? And the reason that's a downside risk, because it sounds great. Hey, the stock market's going up. The reason that's a downside risk is because it will force the Fed to start to have to kind of put its foot on the brakes more firmly. Say, you know what, maybe not 25 basis points at every meeting where there's a press conference. We're going to start rolling out 50 basis point increases every meeting, because this is starting to get out of hand and we got to stop this thing. That's kind of the biggest downside risk market, I think, the second half of the year. So to answer your question, those are the things watching for, not only any kind of sustained move to the downside, but the potential that this could start to ramp to the upside.
And is that more of a judgment call personally? Do you have any way that you would, measurements that you would say, okay, this is what ramping up means? Or would it just be, hey, you're looking at that chart and it's just getting steeper and steeper, and at some point you just kind of call it and say, okay, this is extreme enough for me to think this is not going to end well and you're going to pull out or something like that?
No, that's a great question, actually, because taking a look at fundamentals at this point when it comes to the S&P 500, it's not going to tell you that much at this stage of the game, because the stock market's already really expensive. So, if you become more expensive, but that, where that stops, nobody knows at this point. Really what I'm looking at on a chart perspective is the percentage premium relative to the 200-day moving average and the 400-day moving average. Because, how do you know you're in a mania phase? Is that if you start to get an increasing premium relative to your long-term trend lines, your 200-day moving average, your 400-day moving average. And to see it visually as you pull up a chart of the S&P 500 and you see it elbowing, even on a logarithmic scale, you see the chart just streaking to the sky. And that gap between the 200-day and the 400-day moving average becoming wider and wider and wider. On the flip side, getting an indication that the stock market is breaking down. First to have the S&P 500 fall below the 200-day moving average and fall below the 400-day moving average. And then the next step, having the 200-day moving average fall below the 400-day moving average. Those would be the first two indicators to say, okay, we might be seeing a breakdown. The confirmation of that breakdown is when the S&P will bounce off of any kind of break below those indicators. They get back to the 200-day moving average, or more importantly, the 400-day moving average, and then it fails. Because once you have that break, the bounce back, and then the fail on the retest to break back above, that will usually tell you that the game is on. The bear market you're into the bear market at that point. But you still have time to get out because you're only at the very beginning of it. But so you still have time to act, but you're in it at that point.
This is excellent. I remember, man, it might have been our first interview years ago where I think you brought up that same point about the 200 and 400-day moving averages. And I remember when I heard you say it then, I thought I was typing furiously like I am right now, because I appreciate the metrics involved, because there's so much in investing that, whether art is the right word or not, but it's judgment call, and I think that's one of the things that can be really hard for anyone, especially DIY investors with various time and experience constraints, because that judgment can't be what you'd like it to be for a number of reasons. So when there's any kind of tangible metrics, which again are never perfect, because if any of them were perfect, then they wouldn't work anymore because everyone would be following them. But when there can be some kind of a metric or measurement to be a clearer guide, I'll say I'm just a huge fan of that. And I was actually going to ask you to share that in a minute, but you beat me to the punch. I'm really glad. Yeah. Let me briefly review that. I'm going to review it really quick, what I have here, and you tell me if I'm missing anything, just kind of reinforce it for everyone listening.
Sure.
So, you're looking at, first of all, the first sign that there's going to be problems is that the percentage premium, relative to the 200-day moving average and the 400-day moving average is increasing, which means basically when you're looking at the 200-day moving average of the S&P as compared to the 400-day moving average, when the gap between the 200-day moving average and the 400 is getting wider and wider, basically the 200-day is getting higher and higher above the 400. That's just showing that there is a significant escalation in prices going on, which is just maybe a yellow or even a red flag that, hey, something concerning is happening. But then additional to that, the real confirmation that a bear market would be beginning would be when the S&P drops below the 200-day moving average and then the 400-day moving average. And then additionally, when the 200-day moving average falls below the 400-day, and then when the S&P just cannot recover back to break out above either 200 or 400-day moving average.
Yes. Yeah. That's the only thing I'll add to the first one is that, there's basically three lines. There's the price of the S&P itself, the 200-day and the 400-day. So in addition to the gap between the 200 and the 400-day, you can also take a look at the price of the S&P itself relative to the 200-day and the price relative to the 400-day.
Gotcha.
So if all three of those, and if you really want to fine tune it, you can also throw the 50-day moving average in on top of that. If all of those metrics are blowing out, and one of the ways that you can put context onto that is that you can get price history on the S&P and the Dow going all the way back to 1928, and you can measure what's considered extreme in the past. You start blowing past those previous peaks, then you know you're in a mania. Then you know you're into a blow off top, 3 to 6 month period where stocks have just kind of completely lost their brain and are flying to the moon. Whether that happens or not, remains to be seen. That may not happen to top off the bear market. It could be just that the bear market quits, but that's a possibility that we could see, and that has the potential to be even worse from a bear market that follows perspective. Because if that starts to happen, then the Fed's going to step in and say, "Okay, that's enough." Like they're going to really start pumping the brakes. So that would be the only thing to add to that. But yeah, I completely agree.
Well, I hope you enjoyed this brief interview preview from the DIY Investing Summit. And if you enjoyed anything about this and found any value in it, I assure you, you will thoroughly enjoy the full interview. And you can register for free at DIYinvestingsummit.com. That's DIYinvestingsummit.com. And free registration, and then the summit goes live on June 27th. And so look forward to seeing you there. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.